What if the biggest reason you are not consistently profitable is not your strategy, not your indicator, not your entry model, and not the market conditions? What if the real problem is that every time money is on the line, a different version of you takes control? The calm version of you makes rules. The emotional version of you breaks them. The calm version says, "I will wait for the setup." The emotional version chases the candle. The calm version says, "I accept the risk." The emotional version moves the stop when price gets close. The calm version says, "I will let the trade play out." Breathe. The emotional version closes early because a small green number feels too precious to lose. And then, after the damage is done, you sit there staring at the screen asking the same painful question. Why do I keep doing this when I already know better? That question is exactly why this video matters. Because the problem is not that you do not know enough. The problem is that knowledge and behavior are not the same thing. You can understand risk management and still trade like you are trying to survive an emergency. You can understand probability and still treat one losing trade like proof that you are not good enough. Proof. You can understand discipline and still become a completely different person after a loss, a missed move, or a winning streak that makes you feel untouchable. Most trading education teaches you how to read the chart. Very little of it teaches you how to read yourself. So if you have ever overtraded after promising not to, revenge traded after a normal loss, skipped the perfect setup because your last trade hurt, or taken profit too early because you were scared it would disappear, do not click away. This is the part of trading almost nobody wants to face, but every serious trader eventually has to face. By the end of this 3-part transcript, you will not just understand why traders sabotage themselves. You will see the psychological pattern behind it, 3 inner surrenders that separate emotional traders from consistent traders, and the exact mindset shift required to stop begging the market for certainty, stop trying to control what cannot be controlled, and finally stop treating every loss like a personal failure. The uncomfortable truth is that most struggling traders are not destroyed by the market. They are destroyed by the version of themselves that appears when the market becomes uncertain. They can explain support and resistance. They can talk about liquidity. They can describe risk to reward. They can watch 10 hours of price action education and still make the same emotional mistakes the next morning. They overtrade. They revenge trade. They move the stop. They close the winner too early. They skip the valid setup because the last loss still hurts. Then they enter a weaker setup because they cannot stand watching price move without them. Afterward, they promise themselves it will never happen again. They write rules. They make checklists. They become serious for a few days. Then pressure arrives, and the old pattern returns. This video is not about another indicator. It is not about a secret entry model, a magical candle pattern, or a perfect strategy that never loses. This is about the psychological reconstruction every serious trader has to survive. And I use the word survive intentionally, because the process does not feel comfortable while it is happening. It feels like the market is taking something from you. It feels like your confidence is being attacked. It feels like your intelligence is being questioned. But what the market is really doing is removing illusions. It removes the illusion that you can know. It removes the illusion that you can control. And finally, it removes the illusion that loss means failure. There are 3 major psychological surrenders every consistently profitable trader eventually makes. First, you surrender the need to know what will happen next. Second, you surrender the need to control what happens after you enter. Third, you surrender the fear of loss as a threat to your identity. These are not motivational ideas. They are not just nice quotes for a trading journal. They are deep changes in how you experience risk. Until these changes happen, your strategy will never fully show its real potential, because your emotions will keep interrupting the process before the math has enough time to work. Think about how strange trading really is. You can do everything correctly and still lose. You can break every rule and still win. You can study the chart with discipline, wait patiently, manage your risk, take the cleanest setup of the week, and get stopped out. Then, 5 minutes later, someone else can enter late, emotionally, with no plan, and make money. To a normal brain, this feels unfair. Markets are not designed to reward moral effort on each individual trade. Markets operate through probability, randomness, liquidity, emotion, positioning, and time. One trade is not a verdict. One trade is only one event inside a much larger distribution. The problem is that your brain does not naturally think that way under pressure. Your brain wants certainty because certainty feels safe. Your brain wants control because control feels responsible. Your brain wants to avoid loss because loss feels dangerous. Those instincts helped human beings survive in the physical world, but they can destroy you in the trading world. In the market, the same instinct that tells you to avoid pain may cause you to close winners too early. The same instinct that tells you to regain control may cause you to move a stop. The same instinct that tells you to look for more evidence may cause you to miss the word. Trade completely. This is why trading is not just a knowledge game. It is a behavior game. Let me make the core idea very clear before we go deeper. Your goal as a trader is not to predict the future perfectly. Your goal is to execute a repeatable pledge with controlled risk over a large enough series of trades that the edge has room to express itself. That sentence sounds simple, but it demands a level of emotional maturity most beginners do not have yet. Because to execute an edge over a series, you must stop worshiping the next trade. You must stop treating the next trade as proof that you are smart, talented, chosen, cursed, behind, or not good enough. You must allow the next trade to simply be one data point. This is where many traders get stuck. They understand probability intellectually. They do not accept it emotionally. They can say, all strategies have losses, but when the loss arrives, their body reacts as if something wrong has happened. They can say, I accept risk, but when price comes near their stop, they suddenly feel the need to interfere. They can say, I will follow my plan, but when the chart offers profit, they grab it early because the profit looks too beautiful to lose. This gap between intellectual understanding and emotional acceptance is the battlefield of trading psychology. There is another reason this transformation takes time. The market gives mixed feedback. In most skills, bad execution is punished quickly, and good execution is rewarded clearly. In trading, bad execution can make money, and good execution can lose money. This confuses the learning process. If you take a reckless trade and win, your brain wants to repeat the recklessness. If you take a disciplined trade and lose, your brain wants to avoid discipline. This is why you cannot rely on one outcome to teach you. You need rules, sample size, and honest review. Imagine a trader named David. David is intelligent, disciplined in most areas of life, and deeply motivated. He starts trading with a simple trend-following model. For the first few weeks, everything works. Breathe. The market is trending beautifully, and his first run of trades goes unbelievably well. Trade after trade closes green. At first, he is cautious. Then he becomes excited. Friends start asking him for tips. He begins to believe he has a gift. His confidence grows, but beneath that confidence, something unstable is forming. His identity is becoming connected to winning. He does not realize it yet, but every green trade is quietly building a story inside him. Maybe I am different. Maybe I figured it out. Maybe I am naturally good at this. Then a normal loss appears. Not a disaster. Not a massive mistake. Just a clean losing trade. Price reaches his stop and moves on. But inside David, the loss does not feel normal. It feels like a crack in the story. If he was the trader who could not miss, what does this loss mean? Was the strategy wrong? Was the winning streak luck? Did the market change? Is he not as good as he thought? Suddenly one small loss becomes a psychological event. He takes the next trade with doubt, and it loses too. Now fear enters. He skips the next valid setup, and that one wins without him. Regret enters. Then he takes the next trade out of frustration, and it loses. Within days, his account is not the only thing damaged. His self-trust is damaged. David did not fail because losses exist. Every trader loses. David failed because he had never learned how to lose without losing himself. That is one of the biggest differences between amateurs and professionals. Amateurs try to avoid losing because they think loss is proof something is wrong. Professionals understand that proper losses are part of the business. They still review them. They still learn from them. But they do not let a normal stop loss become an emotional emergency. A professional trader can be wrong without becoming wounded. That ability is not natural. It has to be developed. Now let us begin with the first surrender, the death of certainty. Most traders enter the market believing that if they study enough, they will eventually know what will happen next. This belief is not stupid. It comes from how life usually works. If you study harder, you usually perform better on an exam. If you train harder, you usually become better at a sport. If you follow a recipe, the cake usually comes out right. So the beginner assumes trading must work the same way. Learn more, analyze better, become certain, then make money. The market destroys that belief over and over again. The beginner wants the market to tell him immediately whether he is good. The professional refuses to let one outcome define anything. He knows the truth appears across a series. If 20 or 50 trades show that he follows the plan, and the ledge is positive, he gains useful information. If 20 or 50 trades show repeated rule breaks, he gains useful information. But one trade alone is emotionally loud and statistically weak. Treating one trade as truth is one of the fastest ways to damage your psychology. The market teaches uncertainty through contradiction. It gives you a perfect setup that loses. Then it gives you an ugly trade that wins. It gives you a strong confirmation that fails. Then it moves without confirmation at all. It makes the obvious trade collapse and the uncomfortable trade work. This is not because the market is evil. It is because the market is not a school exam. It is a living auction, constantly adjusting to orders, expectations, liquidity, fear, greed, institutions, algorithms, news, and randomness. You are not looking at a machine that rewards correctness immediately. You are looking at a probability environment. The beginner asks, is this trade going to win? The professional asks, does this trade belong to my edge? That difference seems small, but it changes everything. The first question demands certainty. The second question demands process. The first question makes your emotional state dependent on the next outcome. Breathe. The second question lets you execute without needing the next outcome to validate you. When you ask, is this going to win? You are trying to know the future. When you ask, is this part of my T-edge? You are thinking like a trader. A casino is the simplest metaphor for probability thinking. The casino does not know who will win the next hand or the next spin. It does not need to know. It understands that over a large enough number of events, a small medge becomes powerful. The casino does not panic because one player wins. It does not change the rules because one table had a lucky night. It does not shut down because of one outcome. It trusts the structure. A trader has to develop a similar relationship with edge. Not arrogance, not blind faith, but trust built on tested rules, controlled risk, and a sufficient sample size. This is difficult because trading outcomes are emotionally charged. When you risk money, your brain does not treat the trade as a neutral data point. It treats it as a potential threat. It watches every candle like danger. It searches for meaning. A red candle becomes a warning. Green candle becomes relief. Pullback becomes fear. A missed move becomes pain. And because your nervous system is reacting, your mind starts inventing reasons to act. This is why uncertainty feels so heavy. It is not just intellectual uncertainty. It is body-level uncertainty. When you trade from certainty, you are usually trading from attachment. You want the chart to confirm what you already believe. You search for reasons your idea is right and ignore evidence that the setup is weak. This is confirmation bias in action. A neutral trader asks, what would prove this idea wrong? An attached trader asks, what else can prove I am right? The difference can decide whether a loss stays small or becomes a disaster. The first practical change is to stop asking the market for certainty before entry. You will never receive it. Even the best-looking trade can fail. Instead, ask whether the setup meets your written criteria. If it does, take it with predefined risk. If it does not, leave it. The purpose of analysis is not to remove uncertainty. The purpose of analysis is to identify favorable conditions where your risk is justified. That is all. Once you understand this, analysis becomes lighter. You no longer need the chart to promise you a win. You only need it to show you a valid opportunity. There is a dangerous trap called high confidence bias. Many traders believe their highest confidence trades should perform best. Sometimes they do, but often, high confidence is not real edge. It is emotional comfort. A setup feels high confidence because it looks obvious, because many confirmations line up, because everyone online agrees, or because the chart appears clean. But obviousness can be deceptive. When too many people see the same thing, the market may already be positioned for that expectation. The trade can still work, but the feeling of certainty is not proof of quality. This is why a trader must separate confidence from criteria. Confidence is a feeling. Criteria are rules. Feelings fluctuate based on recent wins, recent losses, mood, sleep, stress, and market speed. Criteria are stable if you write them clearly. When your confidence is high but your criteria are missing, do not trade. When your confidence is low but your criteria are present and your risk is acceptable, you may still need to execute. This is how you stop being a prisoner of emotional certainty. Stay with this, because the moment certainty begins to die, the next trap appears. And this one looks mature, responsible, and professional from the outside. But inside, it is often pure fear wearing a suit. That trap is control. The second surrender begins after certainty starts to die. Once you accept that you cannot know what happens next, another urge appears, the urge to control. You may say, I know I cannot predict the market, but maybe I can manage the trade so well that I can avoid pain. So you start interfering. You watch every tick. You adjust the stop. You close early. You add, remove, scale, re-enter, and second guess. It feels responsible. It feels active. It feels intelligent. But often, it is anxiety wearing a professional costume. The need for certainty also creates hesitation, because no amount of confirmation ever feels enough after you have been hurt. You wait for the perfect candle, then the retest, then the next confirmation, then a little more safety. By the time you finally feel comfortable, the opportunity is gone. Then regret appears, and regret pushes you into the next trade too late. This entire cycle begins with the refusal to accept uncertainty at the correct moment. Before you enter a trade, your plan is usually clearer. You can define the setup. You can place the stop where the idea becomes invalid. You can choose your position size. You can decide your target or management rules. But after you enter, the trade becomes personal. Now money is moving. Now every candle touches your emotions. The plan was created by the calm version of you. The interference is often created by the scared version of you. And the scared version of you should not be allowed to rewrite the plan just because price is moving. This does not mean trade management is always wrong. Some strategies require active management, but there is a huge difference between planned management and emotional interference. Planned management is written before entry. Emotional interference is invented after discomfort appears. Planned management says, if price reaches this level, I will move my stop according to rule. And emotional interference says, I feel nervous, so I will move the stop now. Planned management is part of the system. Emotional interference is an escape from feeling. Trader enters long with a stop under structure and a target at the next liquidity area. Trade pulls back, still above invalidation. Nothing has technically changed. The trader feels heat. He thinks, maybe my stop is too tight. Maybe they will hunt it. Maybe I should give it more room. Brief. He moves the stop lower. In that moment, he has not improved the trade. He has changed the risk after entry because he did not want to be wrong. Breathe. If the trade later wins, behavior becomes even more dangerous because the market has rewarded a broken rule. If it loses, the damage is larger than planned. Either way, self-trust takes a hit. Another trader enters a clean setup, and price quickly moves into profit. Plan says hold. The drainglace not a night, the listins of the skes, but the trader remembers past profits that disappeared. He feels the green number on the screen like something fragile. He closes early. The trade then continues to the original target without him. He made money, but he weakened the system. He trained himself to obey fear instead of rules. Later, when he reviews the strategy, the data is polluted because he never allowed the original tag to play out. A trader who accepts uncertainty does not become careless. He becomes precise. He knows exactly what must be present for him to trade, and he knows exactly what invalidates the idea. Precision replaces prediction. He does not say, this must happen. He says, if this condition appears, I will act. If this invalidation appears, I will exit. That conditional thinking is the language of professional trading. This is why control can be more dangerous than chaos. Obvious chaos is easy to identify. Everyone knows revenge trading is bad. Everyone knows oversizing is dangerous. But control feels respectable. It hides behind the language of adjustment, discretion, experience, and intuition. Sometimes real intuition exists, but intuition is not panic. Intuition is quiet and built from thousands of repetitions. Panic is loud and urgent. If your adjustment comes with pressure, fear, or the need to escape discomfort, it is probably not intuition. The paradox is that you gain real control by giving up false control. You cannot control whether the next trade wins. You cannot control the next candle. You cannot control news, spreads, liquidity, or sudden reversals. But you can control where you enter. You can control how much you risk. You can control whether the trade meets criteria. You can control whether you follow your stop. You can control whether you stop trading after breaking a rule. You can control whether you journal honestly. That is your territory. Everything else belongs to the market. One trader I worked with understood market structure at a high level. He could explain liquidity, order flow, and trend behavior with impressive detail, but his results were flat for years. When we watched his trades, the problem became obvious. He never let a trade breathe. He had an opinion about every candle. He moved stops, took partials early, added back, exited, re-entered, and called it advanced management. But his account showed no advantage because he was not trading a system. He was trading his emotional reaction to movement. We tested a simple experiment. For the next 20 trades, he had to place the trade according to the plan and then stop watching. Stop and target were set. Risk was fixed. No interference allowed. He hated the idea because it felt like giving up. But the result shocked him. His performance improved, not because the strategy changed, but because he stopped contaminating it. His edge had been suffocating under the weight of his control. When he stepped back, the system finally had room to work. One of the most damaging habits is checking your account balance during the session. The moment you connect each candle to your account value, you intensify emotion. A trade that should be managed according to structure becomes a trade managed according to money feelings. Profit creates fear of giving back. Loss creates fear of being behind. Hide the balance if you need to. Trade the plan, not the number. Control also appears as overanalysis. Some traders do not move stops, but they still try to control the emotional experience by gathering endless information. They watch multiple time frames, follow 10 analysts, check economic calendars repeatedly, read news, scan social media, and then become paralyzed. Information overload feels like preparation, but it often creates confusion. The more opinions you consume, the harder it becomes to trust your own plan. Clean strategy can be destroyed by too much noise. Professional traders protect attention. They know that clarity is not free. Every extra opinion takes mental space. Every unnecessary chart adds cognitive load. Heroes worked or fashion. Every alert, message, and screenshot can trigger comparison or doubt. Goal is not to know everything. Goal is to know what matters for your 5. If a piece of information does not affect your setup, risk, or execution, it may simply be noise. Noise creates the illusion of control while reducing the quality of decision-making. The third surrender is the deepest. The surrender of the fear of loss. Most traders believe they fear losing money, but often they fear what losing money means about them. They fear looking foolish. They fear being wrong. They fear that maybe they are not talented. They fear that the dream will collapse. They fear disappointing themselves. They fear telling the story, "I tried and failed." When a stop loss hits, it does not feel like a business expense. It feels like rejection. That is why the reaction becomes so intense. Behavioral finance research has shown that human beings tend to experience losses more intensely than equivalent gains. In plain English, losing $100 usually hurts more than winning $100 feels good. In trading, this natural bias becomes a powerful force. It pushes traders to close winners too early so they can secure relief. It pushes them to hold losers too long so they can avoid realizing pain. It pushes them to avoid valid setups after losses and to take impulsive trades after missed moves. Pain of loss shapes behavior more than most traders admit. Another hidden form of control is needing the trade to move immediately. Breathe. You enter, and if price does not quickly go in your favor, you feel doubt. But many valid trades need time. The market does not owe you instant confirmation. If your setup has not invalidated, impatience is not a reason to exit. A trader must learn the difference between a trade failing and a trade simply breathing. This is why using a stop loss does not automatically mean you have accepted risk. You can place a stop and still emotionally reject the loss. True risk acceptance happens before entry, not after the stop is hit. Before you click the button, you should be able to say, This trade may lose. The loss is planned. The amount is acceptable. And if it happens, I will not punish myself or chase recovery. If you cannot say that honestly, your size may be too large, your plan may be unclear, or your identity may still be attached to the outcome. Proper loss is not failure. Proper loss is a cost of doing business. If a restaurant buys ingredients and some food spoils, that is a business cost. If a store pays rent, that is a business cost. If a trader takes a valid setup with controlled risk and the trade fails, that is a business cost. The problem is not the cost. The problem is when a trader turns a normal cost into a crisis. An improper loss is oversized, unplanned, extended, hidden, denied, or followed by revenge. The goal is not to avoid all losses. The goal is to lose properly. Losing properly may be the most underrated skill in trading. A trader who can lose properly can survive. A trader who can survive can learn. A trader who can learn can improve. Relief. But a trader who cannot lose properly will eventually turn one bad moment into a large setback. The first loss may be normal. The emotional reaction after the loss is what creates disaster. A stop loss hits. The trader feels anger. He enters again without a setup. That trade loses. Now he increases size to recover. The next loss hurts more. Within one session, a normal trading day becomes a psychological collapse. This is why you need rules designed for the emotional version of yourself, not only the calm version. The calm version says, I will not revenge trade. The emotional version says, I need to make it back now. Breathe. The calm version says, I will respect my stop. The emotional version says, maybe give it more room. Calm version says, I will wait for my setup. The emotional version says, if I wait, I will miss the move. Real trading plan must protect you when the emotional version appears. When you interfere repeatedly, you train your nervous system to believe discomfort requires action.